In markets for complex financial services, institutions operate with a structural advantage. They possess nearly total visibility into their products, while the consumer operates in the dark. Economists identify this specific market failure as information asymmetry. Institutions leverage this opacity to maximize profit, often at a direct cost to the buyer. Poor quality mortgage origination serves as a primary baseline, where banks historically sold high-risk loans to borrowers who lacked the data to evaluate the long-term danger. We see the same mechanic in the consumer goods sector, where extended warranty companies utilize bad faith exclusions to systematically deny repair claims. Standard economic theory suggests consumers should learn from these experiences and avoid bad actors. But in these specific markets, a learning paradox prevents that adaptation. Major financial decisions are made too infrequently for a consumer to build expertise. Because the outcomes of a mortgage or a multi-year service contract occur over decades, they are clouded by macroeconomic noise that makes it impossible for an individual to pinpoint the cause of a failure. In 2010, the United States government responded to this structural failure by creating the Consumer Financial Protection Bureau, or CFPB, with the specific mandate of targeting institutional opacity. By 2013, the Bureau's public database had aggregated over 81,000 individual complaints. It was a massive, untested dataset, and it offered a way to measure if transparency actually worked. Correcting this institutional imbalance requires enforcing accountability through two distinct, opposing vectors. Effective market discipline requires both macro-level economic transparency to move entire industries and micro-level contractual enforcement to protect the individual. The database launch in 2013 presented a unique opportunity to answer a central question. Does releasing raw, unverified data actually change how consumers behave? Proving that a public disclosure caused a drop in mortgage applications is difficult. Data is often messy, and correlation is rarely causation. If a bank sees fewer loan applications in a specific county, we have to ask if that drop was simply caused by a localized economic recession. We also have to account for the bank's internal shifts. They might have tightened their own regulatory capital ratios, rejecting more applicants regardless of public complaints. To strip away noise, NYU researchers utilized a triple differences econometric design. First, the model compares a high complaint bank to a low complaint competitor within the exact same county. Then, it compares those banks to another county with identical complaint levels. By structurally isolating these variables, economists can definitively prove whether a public disclosure event directly triggered a shift in the market. Using Illinois data, we analyzed mortgage applications for Wells Fargo and Bank of America in McHenry and Kendall counties. Wells Fargo had high complaints in both, but Bank of America only in McHenry. Subtracting the Kendall performance precisely isolates the disclosure's behavioral impact. The result was a mathematically significant 10.5% decrease in mortgage applications for banks exposed by the database. The researchers also discovered a secondary effect, post-disclosure mean reversion. Losing 10% of a local market share creates an immediate crisis. It forces poorly performing banks to rapidly improve to catch up. This proves that public disclosure acts as a quantifiable, systemic mechanism, forcing bad actors to choose between product improvement and the loss of their capital. If macro data disciplines entire markets, a second question remains: how does an individual consumer enforce accountability when an institution hides behind a dense, confusing contract? The business model for extended warranties relies on high upfront premiums and aggressively low payout ratios. Internal quotas often incentivize claims adjusters to deny coverage. They rely on consumer fatigue, assuming the buyer will walk away after the first rejection. The primary tactic is the use of ambiguous exclusions, like labeling a legitimate mechanical breakdown as wear and tear or lack of maintenance. The primary legal defense against this tactic is a doctrine known as contra proferentem. This is the strict legal principle that any ambiguity in an agreement must be construed against the party who drafted it. Because the institution wrote the contract to maximize their own advantage, they simultaneously inherit the legal vulnerability for its vague terminology. Consider an institution denying an engine claim because a consumer waited 6,000 miles to change their oil, instead of the manufacturer's recommended 5,000. A 1,000-mile delay is a correlation, But legally, correlation is not enough to deny a claim. The legal burden of causation rests on the institution. They must prove that the specific 1,000-mile delay was what destroyed the engine. A consumer can preemptively shatter this argument using an independent diagnostic report. Third-party technical evidence from a certified technician overrides the adjuster's speculation with expert fact, immediately altering the power dynamic of the dispute. To weaponize that evidence, the consumer can utilize the California Consumers Legal Remedies Act, or CLRA. Invoking CLRA Section 1770A14 targets unconscionable contract terms, elevating a standard denial into a direct threat of actual damages. The ultimate hammer in the CLRA is statutory fee shifting. If the consumer wins, the institution is forced to pay the consumer's legal bills. By combining independent diagnostics with statutory fee shifting, the consumer destroys the financial incentive for the bad faith denial. Paying the claim becomes the only logical financial move for the company. Institutional leverage in consumer agreements relies entirely on maintaining opacity. Macro-level transparency, like the CFPB database, allows sophisticated consumers to redirect their capital, forcing systemic market improvement. Micro-level tools, like independent diagnostics and the CLRA, allow individuals to pierce contractual opacity and force compliance. This clearly demonstrates that institutional leverage is an inherently fragile structure. It immediately collapses when met with rigorous documented proof. Information, whether deployed at scale as a public dataset or targeted individually as a legal demand, is the ultimate mechanism for enforcing corporate obligations.